Hello, and welcome to our third video on capital gains and losses. Okay, one of the things that I want to point out to you, there's a very important paragraph at the bottom of page 810. Okay, while it is great to get capital gain treatment so that we can take the benefit of the capital gain tax rates on page 8-8. Okay, it's even better if we can get capital gain treatment where there is no limitation on losses. At the bottom of page 8-10, okay, all right, once you have netted all of your short-term gains and losses together, and you have netted all your long-term gains and losses together, then what you would do is you would net the short-term against the long-term to come up with a net capital position. Okay, and then you are limited to $3,000 of capital losses per year. Okay, so if you have capital gains, you get favorable capital gain treatment by using the table on page 8-8. And if you have capital losses, all right, you're allowed to deduct those losses, but only at the rate of $3,000 per year. Okay, now this applies to straight capital assets, which are defined, okay, at the beginning of chapter 8. Okay, now it also mentioned that depreciable property and real property, when sold, can get favorable capital treatment. Okay, but we can even go better than that. All right, if we take a look at page 812, all right, the subject matter there is section 1231, gains and losses, and this is where real estate falls in. Okay, all right, so let's take a look at what it says in that first paragraph in section 8.6. It says section 1231 assets are not capital assets, but they are given special tax treatment. Gains on section 1231 assets may be treated as long-term capital gains, which is great because then you would get the tax rates on page 8.8, while losses may be deducted as ordinary losses. Okay, now before you go, yeah, but you're limited to $3,000 per year, keep in mind that if this is business property, okay, instead of personal assets like stocks and bonds, okay, there usually is no limit on the losses. Okay, all right, so take a look at the paragraph on page 812 right above the example for Frank Harper. That paragraph is extremely important and you should highlight that. Okay, so let's take a look at that paragraph together. All right, it says, all right, that the calculation of the gains and losses was summarized as follows. You combine all section 1231 gains and losses to compute the net section 1231 gains or losses. If the gains exceed the losses, the excess is a long-term capital gain. Woohoo! Okay, all right, and if you're in the 10 to 15% bracket, ordinary income bracket, all right, you won't pay any taxes because it's 0%. All right, and this is even better. When the losses exceed the gains are treated as ordinary income, and the losses are fully deductible as ordinary losses. So if you lost $30,000 on the sale of a piece of real estate that you were holding as an investment, okay, and you had been using as a rental property, all right, you're going to be able to deduct the entire loss in 1 year against the rest of your ordinary income. Okay, so that is extremely important. Okay, that's very, very important. Okay, all right, on page 813, okay, is another very important provision when it comes to the discussion of when assets are sold. Okay, the assets like stocks and bonds don't have depreciation on them. Okay, only tangible business property and real property would be depreciated. Okay, now you know, the one thing that you have to remember is that if you put a house, and you buy a house and you fix it up and make a rental property out of it, you're going to start depreciating that house over 27.5 years. Okay, so let's say 10 years down the road, all right, you sell that property. All right, well, that means you've had 10 years of depreciation on that property. Okay, and that depreciation is said to be recaptured. Okay, so basically what you do is you add that depreciation back as ordinary income, all right, on your return. The reason why it's recaptured as ordinary income is because when you took the depreciation in the prior years, you took it as an ordinary deduction. Depreciation reduces your taxes, dollar for dollar, all right? And it's just an ordinary expense along with the other expenses that you would have on that property. So when you sell it, you have to add that depreciation back. Now, all right, you can't go back over all those years and try to figure out what your tax rates were in those years. That doesn't make any sense. Okay, so what you need to do first is you have to classify the property as either Section 1245 property or Section 1231 property, which would be the real property, the building and or the land that you hope to get capital treatment on. All right, Section 1245 property is always recaptured at ordinary income levels. All right, Section 1245 property would be, for example, again, you sold a property and it had like a lawnmower that you sold with it and other things. Non-real estate property is considered to be personal property, Section 1245 property, and all gains and losses are treated as ordinary gains and losses. Okay, so any recapture of depreciation in 1245 property is always recaptured at your ordinary income rate. Okay, all right. On page 8-14, they talk about the Section 1250 property. All right, Section 1250 property, okay, applies to property that was pre-1986. All right, in 1986, all property that was depreciated over 27.5 years or 39 years had to use the mandatory straight line rate. Okay, so it's very rare that you would ever see a 1250 recapture again. This would apply to assets that would be at least 32 years old, and you're probably not going to see too many of those anymore. Okay, so the big one that comes in is at the bottom of page 814. All right, 814, and it finishes the discussion all the way on page 823. Okay, so let's take a look at that. All right, what that says down there, it says a special 25% tax rate applies to real property gains attributable to depreciation previously taken and not already recaptured. Okay, well, generally it wouldn't have been recaptured because you had held onto the property, and you only recapture the depreciation when you sell it or when you exchange it. Okay, so basically what it is you look at all the prior depreciation that you've taken up to the date of the sale. Okay, all right. If you look at the very last sentence on page 814, it says, when the taxpayer's ordinary tax rate is only 10 or 15%, the depreciation recapture will be taxed at 10 or 15% to the extent of the remaining amount in the 10 to 15% bracket. And then any remainder is taxed at 25%. Okay? The application of the 25% rate is frequently seen in practice because it applies to every rental property which is depreciated and sold at a gain. And again, you know, it's not unusual for rental property to be sold at a loss, all right, but generally, you know, properties do increase in value over the years, so it's assumed that most of the properties you sell will be sold at a gain. Okay, but the really good example is the one on page 823. All right, so let's take a look at that for a second. Okay, because this pretty much explains everything that we're talking about here. It says Lou acquires an apartment building in 2007 for $300,000, and he sells it for $500,000. Okay, all right. His accumulated straight-line depreciation at the time of the sale is $45,000. All right. So, first of all, ask yourself, what is his adjusted basis? Well, the cost was $300,000. He had $45,000 of depreciation on the property. So his adjusted basis is $255,000, the difference between those two. He sold it for $500,000. Okay, all right. So his gain on the sale of the property is $245,000. Now, how is that $245,000 taxed? All right, well, the first thing they do is they look at the depreciation that he had taken in prior years, all right, and had not yet, quote, quote, recaptured. All right, okay, so the first $45,000 of gain is taxed at 25%, okay, and the remaining $200,000 of gain is taxed at the 15% long-term capital gains rate. All right, so this is very important if you're going to deal with clients that have real estate. All right, you need to explain to them that, you know, because a lot of times they're gonna think that they made a few bucks. All right, you know, probably because they have more money in their checking account than they did at the start of the year. That's how a lot of clients think. And then you turn around and tell them that you actually lost, you know, money on their rental properties, and that'll show up on line 17 of Form 1040, and they can't understand that. All right, and you have to point out to them that, remember that depreciation is a non-cash expense. So it's very possible that cash basis wise they actually made a profit, all right, on their rentals, right? But the depreciation, being a non-cash expense, takes that small profit and turns it into a loss on their tax return. Okay, and then they're very happy about that because, you know, they got to keep the cash and they got to, you know, and they'll pay less taxes. But you have to remind them, you know, that someday they're going to pay the piper. All right, and when they sell that property, all that depreciation has to be added back, all right, at either a 25% rate, you know, or their bracket, and again, it'll all depend upon what their bracket is, you know, in the year that they sell the property. That's why I always caution my clients, you know, if you're going to sell your properties, try to sell them maybe 1 or 2 a year. You know, don't sell them all in the same year, because you're gonna really basically end up paying a flat 25% rate on all that depreciation that you've taken in the past. You know, and they probably, in their ordinary income rate probably wasn't 25% in all those prior years. So the net result is they're going to end up losing money, all right, by selling all these. So, you know, the idea, you know, especially when you're dealing with real estate, is that you want to, you know, sell them off a few at a time to limit the recapture of the depreciation in prior years. Okay. All right, so that ends this video.